Hi everyone, Anthony Palmer, look after investments and products for Carrick Wealth. And I'd like to welcome Rob Enslin, one of the founders of StrategiQ Capital, who are one of the main discretionary fund managers that we use. Welcome to our second recording over this crazy time.
Thank you very much, Ant, and thank you to all the listeners.
So, Rob, what I wanted to go through today is just to try and get a little bit into your mind, what happens, on a daily basis when you're trying to actually make sense of what's going on. I certainly don't envy you. Very, very difficult position to be in, with literally market moving headlines, on an hourly basis, never mind on a daily or weekly basis. We've got unprecedented, stimulus coming in from the central banks. We've got oil. We've got, pretty much no visibility as to the effect that COVID is going to have on the income statements and balance sheets of corporates around the world, and you need to try and make sense of all of this. So, if you wouldn't mind giving our listeners a sense as to how you saw this all unfolding, what type of opportunities lie ahead, what type of hurdles lie ahead, and then we can, I'll ask you some questions at the end. So if you wouldn't mind taking it away.
Yeah, absolutely. Thanks very much, Ant. Before I kick off, I think you're absolutely right. It has been a very challenging environment. I think what's made it very difficult to navigate through is the speed at which events have unfolded. So in terms of market corrections, this is no different to many corrections we've seen in the past. But what has made this quite different is the speed initially at which markets have sold off. And then to the same extent, and I certainly don't think it's over, but to that point, how markets have responded thus far. But I think if you give me the opportunity, I would like to just take you through our unpacking of the markets and how we are judging things at the moment. And really, I've broken down the presentation into three key levels. So firstly, just to take a look at what has happened in the markets over the last couple of weeks. And then following on that, just taking a look at investment themes that we're currently seeing both in the local and the offshore market. And finally, given these sort of views in the market, how are we responding from a house view and an outlook perspective?
Perfect.
Excellent. So if we move over, first of all, just to the last couple of weeks in markets, our last meeting with many of you listeners took place on the 17th of March, and we spoke about the double black swan events that were potentially taking place in markets, being COVID-19 and the oil crisis that was taking place. Fast forward to today, and we're sort of 6 weeks or 7 weeks on from that, and global markets across the globe, whether we're talking in Europe, in the US, Asia, are generally up in the region of 15 to 25%. Equally, markets tended to bottom around the 20th of March. That seems to be where the markets for now have found a bottom. And then also importantly, over this period, the initial market panic where there was just a free flow of selling across the board, across different asset classes, that seems to have calmed down to some extent over the last couple of weeks. We've also seen yield spreads that initially blew out in the part of the panic selling come back somewhat, particularly in the investment grade and the high yielding debt side of the market. And then COVID-19 infection rates has certainly captured the thought process of many investment houses. And it's on daily readings what we continue to watch quite closely to see if we're picking up any trends or early signals that things may be improving in that extent. Over the same period, which has been very encouraging, is that there's been an unprecedented amount of support from governments and monetary policies across the globe. I think what's made it quite different to what we witnessed during 2008 financial crisis is the speed and the coordination that has happened over this period, which has provided some support to markets. And then, yes, absolutely, another sideline show, and I call it a sideline show because under any normal environment it would have been a far bigger story. But there's been quietly an oil battle taking place on the sidelines, and we've seen some roller coaster moves in the oil price over this period. So just to frame that sort of market behavior over the last couple of weeks, the chart below just summarizes what we've seen. So really the blue, navy blue data or bars at the bottom shows the max drawdown of the markets over the recent period. So by way of example, markets from its peak sort of around January pulled back 32% on the S&P 500, representative of the US markets. NASDAQ down 30% odd. And I think the general trend you see is most markets kind of bottomed around the low 30s. Interestingly, though, Shanghai, representing China, where really COVID-19 outbreaks emanates from, had a far less of an impact from a drawdown point of view, only down 12%. Since then, the last couple of weeks have been rewarding towards clients, and there has been somewhat of a rebound. And the white table represents just the extent of that from the bottom move to where we are currently return. So by way of example, a couple of days back on the 27th of April, markets were up 21% in the S&P 500 from its bottom. Similarly, the NASDAQ up 23. And then interestingly, our local market has actually responded quite well throughout this, also up 23%. European markets have been a little bit slower on the uptake. So you can see the Euro stocks up 10 and the FTSE representing the UK up 12. The gold bars really just represent how much return is still left in the markets to get to their previous highs that we witnessed in sort of January, February this year. So essentially the S&P 500 is around 21% away from its high earlier this year. The other point I made earlier on was that markets seem to have calmed down to some extent, and a nice objective way to quantify that is to look at the Vix Index, a measure of volatility 30 days forward of the S&P 500. And whilst the two events or crises are quite different in design in terms of the 2008 Lehman Brothers bankruptcy or financial crisis and the recent COVID-19, the main point is that human behavior is quite similar. So you can see this chart really just shows you the extent of volatility. The higher the number, the higher the volatility. Initially, there was a great fear and panic in the markets. And since then, things have come down somewhat. And very similar pattern to what we saw during the Lehman Brothers crisis. That's obviously over a very short period. If you hone in a little bit longer, volatility is still, however, elevated compared to what we would call a normal environment. So that currently the volatility numbers are around 33. It got up to the sort of 80s, but you can just see prior to the crisis, we were around 10 to 13 range. From a bond market perspective, and really what's happened in the bond markets, and obviously investors tend to focus on the equity side of things, but within the bond markets, what we've witnessed in recent weeks was a blowout of what we talk about credit spreads above sovereign. So if you break the market into three simple categories, sovereign or government debt, then over and above that, there's a slight yield that investment grade debt trades above that, compensating you for the additional risk. And then if you're prepared to take on even further risk in the likes of high yielding debt, the spread is significantly more. But I think the main point to make is both investment grade and high yielding debt blew out in the sort of early stages of the crisis. On an investment grade debt perspective, it blew out by about 3.6% or 360 basis points, and high yielding debt went as far as 11%, or in terms of blowing out from the sovereigns. Encouragingly, the interventions from central banks pumping money back into the system and essentially ensuring that liquidity did not dry up has to thus far sort of eased bond markets, and you can see that the yields have come back. So in absolute terms, they are still elevated, but certainly showing an improved outlook from where they were heading towards. From a global themes perspective, from an investment house point of view, we like to categorize the world in terms of key themes, which just helps us in our decision making. And at the moment, the real key themes on the table from a global perspective are the following six. Now, the first one is pretty obvious, being COVID-19. Some of the other debates that we continue to have as an investment house are we witnessing a global recession? How deep is that recession, and how long is that recession going to be? Is it a V-shaped type recession, a U-shaped, etc.? Also just going to unpack fiscal and monetary stimulus measures that have taken place in recent weeks and months. The oil debate, which we covered in our last meeting with clients, but certainly just want to unpack how things have progressed in that regard. And the question we get, and we've received this question quite a lot over the last couple of weeks from clients and advisors, and really what is asked is, are we witnessing a change in the stance of the markets over the last decade? So are we entering a bear market phase and prolonged underperformance from assets, or is this a great buying opportunity and a blips in the radar, and as clients, is this an opportunity to get invested? So we'll try and unpack that a little bit in detail. And then finally, we are all aware that it is an election year in the US. And just something to be aware of going into the year, it looked like a foregone conclusion that President Trump would regain his second term election. As things have played out in recent weeks, he certainly made a few, what we say, foot faults. And just something to bear in mind that obviously the next president of the USA will have a significant impact on the next 4 years of what markets may look like. So starting off with COVID-19, from an investment house point of view, really focused on the following key regions, the 10 most impacted countries across the globe. So yes, it certainly moved away from a Chinese story to a US epicenter in terms of infection rates. Other key regions, particularly in Europe, are Spain and Italy, and then lesser Germany, France, and the United Kingdom. And then what has also been interesting in recent weeks is that Russia has recently made the top 10 list, slowly creeping up in terms of infection rates. As things stand as of yesterday, there was about 3.1 million cases globally of COVID-19. But importantly, just to weigh that up in terms of recoveries, we've witnessed just shy of 1 million people who have recovered from COVID-19. And it is absolutely a pandemic at this point in time, with COVID-19 finding itself in 185 countries. From an investment point of view, really what has been encouraging, and partly why we've seen this rally coupled with what I would say is the level of stimulus that we've witnessed, has been infection rates that have shown some encouraging signs of slowing down. So if one takes a look at daily death tolls in some key regions like the US, the UK, Italy, Spain, France, generally the picture is quite consistent, that initial ramp up that we've all witnessed through the likes of lockdowns across the board and various measures, that sort of level or velocity of daily death tolls seems to be slowing. Yes, we get some wobbles along the way, but generally the picture is encouraging from that perspective. And equally, if you look at it on a global level, combining all 185 countries, we certainly see a little bit of a flattening of the curve compared to what we were witnessing earlier in the month and in March. From my point of view, probably a nice clear picture of how things are progressing in the right direction is just looking at daily cases. By no means out of the woods, but in terms of that same argument of velocity that seems to be flattening down, and if anything starting to contract a little bit. Really where we want to see this end up is down here somewhere. Now the question we get asked is this a V-shaped or a U-shaped? And to be truthful, I think no one at this point in time has that crystal ball. Data remains very fluid, and as information comes available, new assessments are made of what the outlook may look like. But as it stands right now, I think the general consensus based on what economists are forecasting, along with the pattern that China is following, is that a V-shape for now is the base case. And looking at the IMF projections as a starting point, certainly have that in their expectations. So from a global growth perspective, or the global economy, 2019 growth was at 2.9%. Prior to coronavirus, we were expecting 3.3%. Obviously, that has changed quite significantly. And now from a 2020 expectation, they expect growth to contract by 3%. However, the important point is for now, they forecast that 2021 will look a lot healthier with a strong rebound of growth returning to 5.8% for that year. The picture remains similar for advanced economies with a contraction of 6.1%, followed by 2021 with a growth of 4.5%, and emerging markets, similar sort of picture, a contraction of 1% followed by growth of 6.6% in 2021. So really the region that continues to be sort of the leading indicator at this point in time is China, given the fact that COVID-19 originates from the country, and we talk about 2 months ahead of the rest of the world. And from that perspective, we certainly have seen somewhat of a V-shaped recovery from the economy. So firstly, looking at Pmi Manufacturing Numbers and non-manufacturing numbers, PMI standing for Purchasing Managers Index. After the initial sharp decline, we have seen quite a strong rebound in the March data that has come out. And really important just to point out, a number above 50 suggests an expansion, whereas anything below 50 is a contraction. Similarly, if one takes a look at some cleaner data and more sort of high frequency data out of China. And a good number to take a look at is coal consumption. And whilst coal consumption completely capitulated during this period, if you compare it to previous years, 2017, 18, and 19, there has been some catch up that's happened in recent weeks, and we're almost back on trend in terms of coal production in China. I think a big part from an investment house is trying to unpack how much of the lockdowns is going to change consumer behavior forever, how much is going to change behavior over short periods, and then other industries are not impacted at all. And this is quite interesting just to look at Chinese sort of transportation methods or passenger transportation. And there's certainly been a reluctance from Chinese passengers to get on public networks, so whether it be road, rail, or air. After the initial decline, there hasn't been the same extent of ramp up in terms of those modes of transport. People have substituted those modes of transport for private vehicles. So private vehicles are actually higher than what we witnessed in 2019 in terms of daily vehicles on the road per day. In my mind, I always think of a stimulus, I picture it as a seesaw, and really on the one side, we've had to make drastic measures to the economy in terms of lockdowns, which have impacted economic growth. On the other side of the seesaw has been central banks and governments pumping money into the system to keep the global economy alive and sort of reduce the downside to markets. And from a global point of view, we've really witnessed unprecedented levels of money pumped into the system. From a fiscal side or government side of things, there's a total of around $8 trillion that has been pumped into the market. The large countries in this regard have been the European region as well as the US, parts of Asia. But to that extent, I mean, we know we've listened to it in the news, and even the South African market has put $500 billion rands into its own market. On the monetary side of things, equally, governments have reacted, or central banks have reacted quite aggressively through either cutting interest rates, or for those countries who are at zero interest rates, through quantitative easing measures. And this graph really just shows you the velocity and the speed at which central banks change directions. I'm going to focus on the two key regions in terms of stimulus, being the United States and Europe, and just unpack a little bit more in detail what they've done. So from a US perspective, the first move from the Fed was to cut interest rates to zero by 150 basis points. Thereafter, they pumped $1.5 trillion of liquidity into the banking system. Earlier in the presentation, I showed how yields had blown out. And really an important part of pumping that 1.5 trillion into the system was to just ensure that liquidity didn't dry up and the whole system didn't freeze up. They've also reinstated quantitative easing. So that buzzword that sort of made the headlines during 2009 to 2015 is very much back in play. And in terms of a package, they have an unlimited purchasing of treasuries and mortgage-backed securities strategy in markets at the moment. And then on the fiscal side, government has implemented a total, if you add everything up, around $2.8 trillion worth of stimulus, with the aim of helping small businesses and individuals out directly. If you add all of this spend together, it really amounts to plus minus 30% of the US's GDP. So that is a gigantic amount of money pumped into their system. Equally, the Europeans have been quite active. From their point of view, they've introduced some various measures. So from a monetary policy perspective, they've included purchases of 750 billion euros of additional bond buying to take place during 2020. Really, that package that they've put together, known as the Pandemic Emergency Purchase Program. The ECB, we know, have also cut rates to basically past zero. They'll be buying a total of 20 billion euros per month in existing bonds purchases. And then in their banking sector, they've pumped in around 2.3 trillion euros into the banking system to also help with liquidity and avoid sort of freeze up of those liquidity levels. So combined, their sort of contribution to the GDP region, to the European regions, around 9% of GDP. Remembering that country-specific packages from Germany, France, etc., are not counted in this number. And then lastly, just in one of the themes that we touched on in our last presentation was just what was happening in the oil price. We mentioned that there was certainly a battle taking place between the Saudis and the Russians, who originally Russians did not agree to cut oil production back in March, and subsequent to that, a few things have unfolded. So really, the Americans had to step in because they were the losers in this battle, given their shale gas industry having a much higher break-even price of oil, around $55 a barrel. And with regards to that, Trump really facilitated the various parties to the table, and essentially there was another meeting held in Vienna, a virtual meeting that took place 2 weeks ago on the Thursday. And what was agreed from that meeting was that the 23 OPEC and non-OPEC members would collectively cut oil production by 9.7 million barrels a day. So that was an encouraging move, but unfortunately just a little bit too late and not enough. And we've actually seen oil price continue to be under pressure in recent sort of the last couple of weeks. From a Brent crude oil perspective, currently trading around $23 a barrel, far below what was sort of the break-even number from the shale gas industry that I mentioned. And then the number that caught the headlines, where we got quite a few calls, was just the WTI price, or the West Texas Intermediate oil price, which actually went negative for a brief period in time, negative $40 a barrel. And essentially what's happened there is that they're producing more oil than they have storage space. So as they continue to pump oil out of the ground, there's nowhere to store it. So there's essentially dumping needing to take place in coming weeks, and hence we saw a negative number momentarily in the oil price. Important to remember, a low oil price is obviously negative for countries that produce oil, but for the rest, like South Africa, it's a free stimulus package essentially. Moving over just to market behavior and just looking at previous sell-offs, and I'm going to focus on the S&P 500 and look back to 1957 and what's happened. And we use the S&P 500 just given the richness of data that we have, as well as being one of the most followed markets in the world. So first point to take out from this table is pullbacks in markets or sell-offs do happen, and they happen on average once a decade. There's been give or take 10, 11 pullbacks over the period. And on average, a pullback is around 35%. So the recent sell-off that we witnessed in markets, which kind of got down to 32%, was no different to what we've witnessed in the past. What made this sell-off very different was the speed at which it happened. So on average, that 35% sell-off in markets took around 9 months, 271 days to get to a bottom. This sell-off took a mere 21 days to get there. Encouragingly for clients, and this is not to say that the future will be the same as the past, but based on history, thereafter, the markets on average returned 60.4% to get back to its original high, and it took 535 days, or just short of 2 years, to get there. So the question mark is, what does this look like for the coming period? But perhaps an even more powerful chart to look at, and of the entire presentation, for me, this is hopefully the one that you will all take from. And this looks again at the S&P 500 from 1995 to 2020, so 25 years of data. And it looks at returns in the market based on various strategies. So strategies of trying to time the market. Essentially, if you had taken $100,000 in 1995 and just invested in the S&P 500 and left it, done nothing, through various crises, whether it be the dot-com bubble, financial crisis, the current COVID-19 crisis that we're going through, your $100,000 would have grown to $856,000 odd, or an annualized return of 8.97%. During that 25-year period, if you just missed the 10 best days in the markets over that period, your return would have been significantly diminished, down to $392,000 odd, or 5.62%. And really, the table just shows you as you go along in 10-day increments how your return has been diminished. So if you had missed the 40 best trading days in the markets over 25 years, you actually end up with less money than you started with. You end up with $97,000. Coupled with that, probably an important question to ask is, when did those great days happen? And interestingly, almost all of those great days, the 30 best days, a large part of them happened during crises. So of the best 30 days since 1995, 20% of them happened during the dot-com bubble burst, 40% of them happened during the financial crisis, and 20% of them have already happened during COVID-19. Only 20% have happened in a normal environment. So the point of this question, or this slide, is really to clients, stay invested. Don't try and time markets, because even the best investors in the world struggle with that. And in all probability, you will end up missing some of these great days by trying to time markets. So really wrapping that up and putting it all into one slide in terms of a house view, I think it goes without saying that we are living in unprecedented times. Just the mere fact that we are presenting in this format suggests that. And perhaps the modern world that we know it hasn't had to go through suffering to this extent. Our grandparents and our parents may be the last to have witnessed something like this during World War II. We've had to make the decision between life and economies, and as a result, we've created what we call a self-imposed recession during the first half of this year. But importantly, what we're telling clients is that this is not a financial crisis that we witnessed of 2008. For now, it's a crisis of confidence, and as and when confidence returns, the shape of the recovery will be dictated by that. So if we're able to see an improvement in COVID-19 infection rates and or a vaccine, coupled with the amount of money that has been pumped into the system, we could very well see a V-shaped type recovery. And then really following on from that, China is the leading light, and based on the shape of the Chinese from sort of infection rates to recovery, it's taken give or take 3 to 4 months. And on that basis, scientists expect sort of September, the time where things would have really settled down for the globe, all else equal. Something just to park in the back of your minds and just to be aware of, whilst COVID-19 finds itself in 185 countries, for now it is very much a developed market crisis in terms of infection rate levels and speed at which the pandemic has played out. The challenge for emerging markets, if we see similar sort of patterns, would be that we know that people in emerging markets live in far closer proximities to one another. Government's ability to spend their way out of it is less, and just healthcare systems are a lot more compromised. So certainly be a lot bigger crisis if this makes its way to certain emerging market regions. We've touched on central banks, but central banks have played an important role in calming down markets over the period. And once things normalize, the amount of money in the system should go a long way to supporting risk assets. And then just importantly, of the entire presentation, the thing that I have the most confidence in stating is the fact that with absolute certainty, the COVID-19 virus that we're experiencing at the moment will eventually pass, and markets will eventually return to normality. And in that, great opportunities will emerge and are currently emerging to our clients. We're encouraging investors just to remain long-term focused, not try and time the markets and try and make a quick buck in terms of the volatility we're witnessing. Spend time with your financial advisor at Carrick. Make sure that your risk profile suitably aligns with your ability and willingness to take risk, and then leave the decision making essentially to the investment manager. And then lastly, just remain calm and disciplined in these types of environments currently during COVID-19 and as things play out. I'm going to move on to the local market and provide a little bit of insights to what's happening there. And from a themes perspective, the three key themes that are really present in markets right now is firstly the downgrade that we've recently witnessed that came at a bad time for the South African economy from Moody's. Secondly, the same questions, the South African recession and stimulus package that we've just witnessed. And then just finally, in the local market, is this a bear market? It has been a bear market for some time, or is this now the great buying opportunity? So to kick things off, just from a Moody's perspective, we know that Moody's recently downgraded South Africa's sovereign credit rating, which essentially meant that as a collective, we are now non-investment grade. So any investment manager running an investment grade mandate would be a forced seller of South African sovereign. Really and that comes on two levels: active managers, which we believe many of them have already made that decision, and then equally in passive strategies. The amount in terms of exiting South Africa today is the last day for them to do so. So we have seen some volatility in the exchange rate coupled with all the events that we're aware of. From an estimate point of view, roughly about $5 billion to $11 billion US dollars could be or have been sold off during this period. Another important question that we get quite frequently is the Rand and our expectation of the Rand. So I'm just going to put a disclaimer out there. From a Rand point of view, it's always been historically a very difficult number to forecast, whether there's often quite a big discrepancy between the theoretical value of the rand relative to reality. And we prefer to look at the rand in terms of ranges, so when it's overbought and oversold. The good starting point is just to understand the bond yields of the market. And really, as things stand right now, and you compare South Africa to other emerging market countries that are either last level of investment grade or one level below, so similar to South Africa. The table below just looks at anything below the orange line is non-investment grade, above is investment grade. But the sort of key countries that are comparable to South Africa would be Russia, Hungary, Brazil, Turkey. And if you look at their real yield, so you just simply take the 10-year bond yield and subtract their prevailing inflation rate now to get a sense of real yield, South Africa certainly stands out as attractive on that basis. For this same reason, we are very constructive or like South African bonds at the moment. We think they offer a great real yield above inflation. And based on history, this is certainly at a nice elevated level. And then also just coupled with that, just looking at the rand in a real exchange rate perspective. So not only relative to the US dollar, but rather to a basket of currencies. One can notice that the rand currently is trading at a much higher level than what we've witnessed in sort of the last 20 years. Other periods would have been 2000, 2001, financial crisis, and then Nenegate. However, history might not be the same for this graph, because during these periods, South Africa was an investment grade currency. That dynamic has changed. In our minds, sort of the upper and lower bands have moved up a notch from a currency perspective. So from a fair value, theoretically, the rand should be around 1750 right now. Similar to what I've showed you on the S&P 500, if one does the same exercise on the all share index, and going back to data from 1969, there's been roughly 8 or 9 pullbacks, and on average those pullbacks have been around 40% during that period. We recently just witnessed a pullback of 31%, and similarly to the previous shapes, it took around 14 months to get there. What made this one different is it only took us a month to get there. Encouragingly though, the 12 months thereafter, on average, the market returned 30%. Over 24 months, the market returned 39%. And over 36 months, the market returned 69%. So again, I'm going to say history is not to repeat itself every time, but if you use this as a guide, generally speaking, enduring sell-offs, the years ahead often produce superior returns for clients. The fiscal and monetary stimulus package that we've just witnessed, just a few points to make there. We've had various levels of stimulus in our economy. The first being the 200 basis points cuts that the economy's witnessed, which amounts to roughly 80 billion to the South African economy, or 1.2% of GDP. The 500 billion relief package that's really aimed at individuals and small businesses represents around 10% of South African GDP. And then the free lunch that we receive from the oil price is a roughly 50 to 70 billion, which is about 0.8% of GDP. So collectively, that's a lot of stimulus in the South African economy relative to its size. And then I think South Africa has actually been quite a leading light in terms of how to deal with lockdown, in terms of the staged approach. I know it's obviously quite frustrating as individuals, but we can certainly be proud of our government in terms of how they've handled the lockdown. And we will more than likely see more countries follow this different level of approach. Putting it all on paper for the South African economy, I think we face a much tougher challenge. We were already weak going into this. So COVID-19 came at a really tough time, and then coupled with Moody's downgrade making our funding a lot more expensive. And really Moody's put it quite well in terms of South Africa's weakness at the moment. And many of these we're all aware of in terms of unreliable energy supply, weak sort of confidence on the business side of things and spending in the economy. And then our labor unions, or the structuring of our labor market, is very rigid. I think labor unions trying to negotiate wage increases in recent weeks just proves how out of touch they are with reality in terms of the challenges that the South African economy is facing. From a fiscal deficit perspective, prior to the stimulus package, we were looking at around 8.5% of GDP. We were included in a conference call hosted by Goldman Sachs. And really there, the expectation is that we may see GDP north of 10% for 2020. So certainly a tough environment from South African point of view, and may very well need an IMF bailout. They've already gone to the IMF from a stimulus point of view, but yeah, direction's changing. If we were to take a positive out of this and take a positive half glass full perspective, the complacency that we've seen in the South African economy over the last decade and the inability to make decisions is no longer, that luxury no longer exists. So if anything, this may be the fire that ignites the economy to make decisions. At the end of the day, we can save as much as we want. The South African economy needs growth to grow our way out of this. And this may be the catalyst to changing things. And then also just to add to that is, keep in mind as investors that the South African economy at the end of the day is very driven by the Rand hedges. The Rand hedge component of the whole share market makes up roughly 60% of the overall market. So all else equal, a weaker dollar should, the weaker Rand to the dollar should theoretically be an underpin to the local market. And then lastly, we are at the end of the day a price taker. We don't make decisions in the bubble. And if emerging markets do return to favor as risk returns to markets, we will certainly be pulled along that trend. In closing, and just putting it at a high level, breaking the asset classes into the broad assets, on an offshore perspective, over the period, we've decided to upweight our neutral call on equities to a moderately overweight call. We're obviously massaging those decisions into the portfolios over time, but from an asset allocation 12-month outlook, we've upped that, and that's driven from the bottom-up valuation opportunities we're seeing in markets. Whilst underlying valuations are similarly cheap in offshore property, we are less encouraged to increase our exposure there, and that's really just our view that bricks and mortar type business models may take a bit longer to recover, and as a result, we're holding that neutral call. Where we've been quite active over this period is to cut our bond exposure, particularly long duration bond. We think the payoff profile for long duration bonds certainly doesn't warrant or give clients a decent payoff profile. It's a very broad asset class, so within there still remains opportunities, but as a collective, we're underweight bond exposure and prefer at this point in time to hold cash or cash-like instruments, low duration type instruments as an alternative for cash. For bonds at this point. Turning our attention to the local markets, we're all out overweight on equity and fixed income. We just think that both these asset classes provide a real adjusted return that is relative to its own history, and the other asset classes really attractive at this point in time. When it comes to property, we follow the same sort of thinking pattern as we spoke about on the offshore side, and therefore we hold a neutral call. And then because of the attractiveness of SA equity and fixed income, we're underweight cash. We just think as an opportunity cost right now, we're better served in the other asset classes. I alluded to it slightly in the currency side of things, but our ranges on the Rand at the moment are 16.50 to 19. Those are the sort of touch points. So anywhere around 17.50 around fair value for us. So yeah, really that puts it into perspective what our thoughts are, and I think I'm going to open the discussion to ads.
Thank you very much, Rob. Always extremely insightful, and you distill it into a very understandable format. So thank you very much for that. What I'd like to do is just touch on some real life sort of experiences that we are going through with our clients. We are communicating with our clients as frequently as we can to help them navigate these tricky times. But there seem just to be curveballs thrown at them all the time. If you look at the lowering of interest rates around the world and in South Africa as well. In South Africa, where you were getting 7.5+% in a money market account, that's going to be whittled down tremendously. You take tax off, and you're looking at 3.5%, which is below inflation. So now clients are saying, well, that cash that I was sitting with, what do I do with that? Clients that were in cautious portfolios that weathered the storm a little bit better are saying, do I maybe take a little bit more risk now to take advantage of the markets coming back, and then over time bring the risk back down to more of a considered level for their risk profile, risk tolerance, etc. So there still is a lot of uncertainty, and it's quite difficult to navigate. I must say the lower risk income notes that we use have really helped our clients through these times, because they offer that more certainty or increased certainty of income with downside levels of capital protection. So your thoughts on that would be interesting, because as you say, on your previous slide, your offshore bond exposure had 2 red arrows going down. You're reducing weight there. What are you buying?
Yeah. So I think I'm going to tackle, first of all, the South African money market debate. And, most people would have argued, based on the last 30 years of information, that there's an opportunity cost to sit in money markets. And we would agree with that. However, prior to what we've recently witnessed, money markets were actually providing you a decent risk-adjusted return. And that was simply driven where interest rates were relative to inflation, which meant that you were, for a moment in time, actually capturing a real return relative to inflation. Fast forward 6 weeks, and that's changed quite a bit. A few things have happened. On the one side of the equation, the Reserve Bank has cut interest rates by 2%. And money market yields will follow that direction. So they've moved a lot closer to inflation, if you want to call it that. And once you start stripping out fees, like you correctly say, you actually end up with a negative real return. And then on the other side of the equation, asset prices have become, in terms of what we favor being SA equity and fixed income, have become far more attractive. So you've got to weigh that opportunity cost up as well. And we certainly think that doesn't make sense at this point in time to be in money market type strategies long term. And then moving over to the structured notes type debate, or where yields are at. So in the developed world, interest rates are certainly close to zero, certainly in the sovereign side of things. So there's a risk investing in those types of products right now. As an investor, if you were to invest in a long dated 10-year, for example, US Treasury, your yield is below 1%. It's been changing quite significantly over a couple of days, but somewhere below 1% for 10 years is certainly not a decent payoff profile. And then coupled with that, the amount of stimulus that we've witnessed theoretically somewhere along the line could produce inflation, and with inflation is higher interest rates. And the way bonds price, that would be actually a depreciation in your capital. So there's a big capital at risk with a very low payoff profile while you wait. So we don't think that makes a lot of sense. From a structured notes point of view, we've almost categorized it as a synthetic bond at this point in time. So the likes of some of the programs that we've seen that Carrick, for example, have put in front of clients, that's a nice alternative at this point in time as an income or yielding type safe asset to replace traditional bonds alongside your growth type assets like property, some of your alternative asset classes and equities.
Okay, and then clients that are sitting on cash that are relatively young, they've got a 7-year plus time horizon, and they've got appetite for risk. They're saying to us, show me something that's a little bit more risky in the equity space. I believe that there's going to be a stronger recovery than we've seen. And let's go for it, and let's try to get some nice returns. In general, yes, that would have been the right decision around about the 20th of March if you had timed the market perfectly. But like you quite rightly say, markets have bounced back, let's say 25% on average. How much more room have they got to run, and what type of downside risk is this market still facing?
Yeah, so I think that's the $1 million question that everyone would like to know. The truth of the matter is, because of those decisions are so difficult to quantify and get right, we try and tend to push the discussion away from timing the market or the short-term sort of opportunities in markets, and rather focus on the longer-term picture. And why we say the longer-term picture is important is it's important to ensure that the investment decision you make today is designed to meet your long-term willingness and ability to take risk and meet your long-term goals. Markets will go through volatility. They have historically, and they will going forward. And during those times, you need to be in an investment strategy that meets your behavior. Otherwise, what you tend to do is make very poor decisions. And to that point, just given what has happened in the markets, I would rather suggest that one allows that decision making to take place at a portfolio level. So rather allow the investment professional that is looking after your money, or the investment manager, to make those decisions when to increase equity exposure or reduce equity exposure. essentially by sitting in cash and trying to time the market when entry and exit, you're doubling up on that call. And 10 to 1, you'll probably get it wrong. If you had to ask me as a house, alongside that, what do I think over the last couple of weeks? I do believe that asset prices have moved a lot faster than I would have anticipated. I can understand why some of the stimulus and the support has encouraged markets to look through this. From our structuring point of view, we are still sort of cautiously building into equity positions. So as much as I've showed you a previous slide that we are overweight, we certainly haven't got to that level overnight. We do think that the potential of volatility and drawdowns in the coming weeks is a potential. As a result, we're slowly building positions into equities.
Okay, and then final question: what trades, if any, have you done or strategic capital for your clients' portfolios? Since the corona virus or pandemic, started taking its toll on the stock markets.
Yeah. So I'm going to break that into local strategies and then offshore strategies. On the local strategy front, we've increased our equity exposure, and we've also looked at our underlying managers. And then in our PSP strategies, we look to improve the quality of the portfolio, and that's just been driven by asset prices being attractive. So certain companies that we've always liked, but we just couldn't pay the price for them, all of a sudden were available or on sale, and we took advantage of that. In the solutions, as I mentioned, we've increased that equity exposure as well as topped up on our existing bond exposure. And then on the offshore side of things, we've been a little bit more measured, just given where we've come from. Early on in the crisis, what we decided to do, given that yields had compressed so quickly and that some money was made on our duration portfolios, we liquidated those into cash. And since then, we've slowly started to deploy some of that cash to up the equity dial, but we by no means sort of full throttle on our equity call yet.
Okay, when you say that you reduce some of your duration holdings, you're talking about longer dated government bonds.
Longer dated government investment grade debt that we held in the portfolio going into the sell-off, and given the extent to which particularly the sovereign debts compressed and provided us with an opportunity, we lightened up on that. So there's been twofold. It's to bring down duration and bring down credit spread risk, essentially, in the portfolios.
All right, perfect. Rob, thank you very much. In closing, I'd like to say thank you to everyone that's watched this, and just wish everyone safety and their family and friends over this period of time. And Rob, I look forward to speaking to you again shortly for our next snapshot of the markets.
Thank you.